Hey, how's it going, everybody? I'm your crypto sensei for the day, and welcome back to the Satoshi Club. Now, today I want to talk to you about the benefits and drawdowns of crypto versus traditional banking systems and whether or not regulation actually makes things better. So I'm going to start off with a little intro into the DeFi space, so how this decentralized finance sector actually came to life and what is it useful for, compared to traditional banks in the traditional banking system. I'm also going to talk about risks both in cryptocurrencies and traditional banks, and also some top banks and which crypto projects they have invested in, so you can have a little bit of a insight into that as well. You can call it inside info if you want, but this is publicly available information, so everybody already knows that Morgan Stanley, Goldman Sachs, and all of these big players, even though they're huge investment banks, they are still entering crypto. They're not trying to fight it anymore. They are literally just trying to hold as much as possible. So if you do enjoy the video, I would appreciate it if you smash the like button, subscribe down below, leave a comment if you have any questions, and if you haven't checked out my community on Twitter, I strongly recommend that you do give us a follow. It's going to be linked down in the description below. It's a full-on educational group, Twitter spaces, chatting, even a huge Discord community, Telegram community, everything is right there. There is going to be a pretty cool talk coming up in a few days, till August 11th at 4 p.m. You can set a reminder right here, but in general, I follow up on all of the news going on, and there's a lot of interesting stuff. For example, this Flow, if you guys have heard of the Flowverse, the Flow chain and everything, actually partnered with Instagram. Now, you wouldn't have known this information if I didn't tell you about the Satoshi Club Twitter page right now, so head on over in the description down below and give us a follow. Now, the first thing I wanted to talk about is UniSwap. So UniSwap is one of the first DeFi networks out there, right? It's one of the first decentralized exchanges, and currently it is one of the largest with a trading volume of over $1.1 trillion, over 100 million all-time trades, 300 plus integration into a growing network of DeFi apps and all of this stuff. And the whole point of why UniSwap was actually released, and this is how it actually looks, all you need to do is connect your wallet, is to remove the need for a middleman or a third-party authority that is there to control your finances or your transactions. So sometimes if you go to a bank, if a lot of people went to the bank before you and a bank run is happening, you're unable to take your money out. Now, this can happen in both a bank and also in crypto as well, but what is there to actually protect you from this happening? You can't possibly think it's a third-party authority, because obviously even banks succumb to bank runs, so it's all about the solvency and the liquidity. And the reason or the way that these decentralized protocols actually keep their solvency high is by allowing people to both exchange currencies from one to another, and by currencies I mean crypto, or they can actually participate in these liquidity pools. So what basically happens and how this system is portrayed and viewed as an automated market maker, without the need for any bank, without the need for any banker to take a commission on your money, without the need for somebody to tell you you can't withdraw, you can't deposit, you can't get a credit, you can't get a loan. Well, crypto is there to enable a financial system fairer and accessible to everybody. Even people who don't have fresh water around the world, some projects are aiming to provide them with a financial system. Now, how useful is that? Well, that's a topic for another day. But for now, it is a very simple way that these automated market makers or UniSwap actually work. First of all, you connect your wallet, and then if you want to swap from one token to another, all you do is you choose one token. For example, you have Ethereum in your wallet and you want to swap it to one of these ape coins, for example. Then you type in the amount of Ethereum you have in your wallet, and you very simply just swap it into ApeCoin. So that is how you swap from one currency to another, and there is no exchange fees. The only fee that is being paid is the gas fee on the Ethereum network. So as Ethereum becomes stronger and stronger and faster, the gas fees will go lower, and over time they will be reaching close to zero. Maybe not on Ethereum, but there is a lot of other decentralized exchanges such as PancakeSwap that work on the Binance Smart Chain that do allow you to trade using BNB, which has a lot lower gas fees than Ethereum usually does. So how do they actually have all of this ApeCoin here? Who are you buying this ApeCoin from? Well, people participated in the liquidity pools. So if I'm one of the guys that wants to put my money to add liquidity into UniSwap, all I need to do is connect my wallet, add my money there, and they will pay me an interest back on the money that I'm holding in the liquidity pool. And then this money in, for example, ApeCoin that I keep in the liquidity pool is used for other people who want to swap Ethereum to ApeCoin. It's a very simple process. This is what's known as the automated market maker, and this is how the basis of all DeFi or decentralized finance apps actually work on. So it's very simple, it's very straightforward, and it works. Now, the one big problem about DeFi is the lack of regulation, right? So a lot of different protocols were hacked, a lot of this stuff happened. So it all obviously comes with some type of a risk. Now, this could also happen, there's also banking risk, there's transaction risks, there's a lot of different risks out there that you as a consumer shouldn't really care about that much. So you want the platform or the bank or wherever you're investing into, you want it to be as safe as possible. And to be honest, currently and nowadays, it is, safer to invest with a bank, but you have more freedom if you do invest with crypto. So it's all a little scale, as crypto grows and as crypto gains a market cap that is larger and larger over time, there will be less volatility, less manipulation, and at some point it will be ideally and hypothetically, it could be a perfect system out there. But we're a long way from that, so let's talk a little bit about the risk of cryptocurrencies. First and foremost, Bitcoin was born to eliminate the need of third-party payment systems or the middleman. As I said before, the bank is the middleman. They do have a certain level of control. Sometimes that is good for us in the case that, for example, if something happens with the market, the bank will not just lose all of their money and not pay us out. But at the same time, it has bad things as well because, if the market does good, then the bank just pays their own interest rate and you don't get anything extra. So it all has its ups and downs. But, today's role of financial intermediaries is to, try to comply with regulations and also make everything as safe as possible. Now, Bitcoin, so talking on the crypto side, Bitcoin is required to comply with KYC, know your customer, and AML, and anti-money laundering principles as well. So there is some form of regulation already going on with crypto exchanges. But, at the same time, even though there is a high level of security on Bitcoin itself, right, since it's on the blockchain, a lot of these other protocols have succumbed to a lot of different hacks, attacks, breaches, which makes people's trust of crypto not really kept at that high of a standard, right? So Bitcoin is actually one of the strongest networks out there. It was never hacked, so that's Bitcoin itself, but crypto in general has been hacked a lot of times, which makes the results to this one survey that was actually conducted pretty favored towards banks. So a lot of people see crypto as a risk more than an opportunity. A lot of people disagree that crypto transactions can be monitored. A lot of people, a lot of this stuff is just pointing towards a general lack of trust in crypto, but that just comes because there's not enough people in the crypto world currently, right? As the market cap grows, people will know, and people will grow as well, and people's education about crypto will grow as well. And also all of these DeFi protocols will expand, they will get regulated, they will become better and better, but they will never become the same as banks because they are automated. They don't actually have a middleman. Now, some of the risks of regulated banks is obviously they launder money. Everybody knows that. It was released, in a lot of reports back in the day. More than $2 trillion were laundered. You have money coming from all sides, bankers just accepting it. They love your money, and that's just how it is. But sometimes one of the risks of regulated banks is just making less money than you could in crypto. That could be seen as a risk, and opportunity could be seen in the crypto market. For example, if the bank offers a interest rate of 2% on a yearly basis and inflation is 4%, obviously you're going to have no use investing in a bank. But at the same time, if inflation is 4% and one of these crypto decentralized exchange yield farming protocols offers 6% return, then why not actually use it? Now, the risk there is that they could shut down. So more risk, more reward, less risk, less reward, less volatility. It's all a balance once again. One thing that banks should do, and what they are doing, is investing in technology into the future, which is why I believe, and it's a completely probably well-known thing, that blockchain will have a large role in technology in the future, in the banking system sector, and basically everywhere else as well, because it is, tamper proof. It's a lot easier to secure, and it is just so much more efficient than current technologies out there. Now, a lot of the top 100 banks have invested into crypto companies. Around 23 of them had made at least one investment in blockchain or crypto. And if you want to learn more about what they're doing, I'm going to leave this link drop down in the description below. Also, if you want to learn a little bit more about other crypto stuff such as Bitcoin, inflation, stable coins, and all of these things, check out my previous videos on the right hand or left hand side. And you may just learn a little bit more info especially if you're a beginner or intermediate guy in the crypto world. I do spread quite a little bit of knowledge, so this is the Satoshi Club right here, which is going to teach you a lot about crypto itself. But I digress. Morgan Stanley has a significant holding in Figment and NYDIG. You have Goldman Sachs there, BNY Mellon, Commonwealth Bank, Citigroup, HSBC, Wells Fargo. You guys all know about these banks right here. And something that does keep repeating a few times is Talos right here. So that's maybe some info that you should, go ahead and research Talos a little bit. But in general, a lot of banks are investing into crypto, which is a good sign for the crypto market as a whole. Now that's it for today's video. I'm not going to get into too much more depth right here. I'm going to talk about banks in several new videos in the future. But one thing I want to let you know with the Satoshi Club, if you want to learn more about the crypto market in general, about what's going on, news, events, give us a follow on Twitter and set a reminder for this event coming on Thursday, August 11th. So that's it for today's video. I hope you enjoyed it. Lastly, I'm not a financial advisor, and you should do your own due diligence before investing into anything in the crypto world, and I will see you all in the next one.